Financial freedom is when you could pick up your stuff and you could walk out of your job if you want. You could do what you want with comfort. And I call it personally a decision age. It's an age where if you said, hey, I don't want to go to work today anymore and I'm done, you could just not go to work and there's zero consequences to doing that. It's not going to impact anything. You're doing something because you enjoy it. That's freedom. The biggest issue and I regret is a failure to plan. It is unanimous across the board. And one that honestly, I mean, I see quite a lot is people put money in RRSPs without a plan to withdraw it. People relentlessly put money into RRSPs because that's what they think they should save their money. And they're not thinking about why they're doing it and they're not thinking about how they're going to draw it out. Because to pull that money out in retirement, it increases your income. It can become very expensive. And if your income gets too high, you might lose things like OAS, being a higher bracket, more taxes. It gets more and more expensive the more money you make in retirement.
Welcome to the Ontario Homeowner Show. I'm Mohsen Lakhani, and this is the show where we get real about what it takes to own, maintain, and love your home. From renovations to raising a family, legal insights to mental health, no topic is off limits. This is about real people, real value, and real conversations to help you live better, right where you are. Each week, I sit down with trusted experts, service professionals, and local changemakers to bring you the strategies, stories, and solutions that make homeownership easier. This is the Ontario Homeowner Show, powered by the Vaughan Real Estate Advisors. Are you ready? Let's go. Rodney, thank you so much for joining us at the Ontario Homeowner Show today. It is an absolute honor to have you. How are you doing today?
Thanks, Mohsen. Thank you for having me. I'm doing great. Can't complain. I'm happy to be here. Happy to have a chat, learn more, and hopefully help some people.
Amazing. Well, before we even get into the depths of it all, do you want to start by telling us what is it that you do?
What I do and how I position myself, I'm a comprehensive wealth manager, really focusing on financial planning and portfolio management. The way I position it to a client is think of it as your personal CFO. The client is the CEO. They make the big decisions. They have the grand vision of what are we trying to accomplish. I'm their partner that clarifies it and says these are the steps that need to happen to make it happen, and lets them know where they're at on their journey to. Are they on track? Are they behind? And then how do we make it better? How do we make it more efficient? What we want to provide is clarity on cash flow and assets. So where does the next dollar need to go? Do I need to invest it in this account, this account? How do I allocate it? And then, of course, how do we invest the money once we do have it to maximize that growth and after-tax rate of return within the risk profile? So it's not just investments. I say it's for anything financially related. We want to be that resource, that personal CFO. Come to us. And if not something we can handle, they need real estate help, send them to your team, Mohsen. If it's, legal help, we'll send them to our lawyer contacts on our team or accounting, et cetera. We want to make sure that they're getting the right service, but I say come to us first as your contact, and then we'll make sure we get you in touch with the right people to get the job. Then if it's not us.
Amazing. How did you get into this industry?
Yeah, it's well, I mean, I've been doing this since university actually. So I joined wealth management really right out of school. I was in accounting and finance, and kind of had a pivotal moment where I didn't really want to do the accounting side as much. I wanted to work with people, and I just started Googling the best ways to work with people. And ironically, the two options that came up were real estate and financial advisors. So I kind of said, hey, I'm in finance already. I'll go that route. And, 15 years later, I haven't looked back, and I've loved every minute of it. But it really is one of the, unique areas I found where you get to help people, help grow their wealth, could coach them, see their families grow, and it's a generational thing. And you get to know people very well, and I think that's been the truly most rewarding piece of it, where it's amazing where you kind of see yourself transition over 15 years, and I'm so excited about the next 30 that I have down the pipe. So it's exciting. It's exciting. No regrets. It wasn't where I imagined myself when I was in high school, but happy we're here.
Amazing. Share one piece of outdated financial advice that you see people still making.
Probably the main one, and is people think a tax-free savings account is a savings account. And I still see this, but maybe it's because of the name. It's probably the name, but the banks really drilled it into us when this account came out in 2008 that you pop in your savings, you earn 1%, and you let your money kind of grow slowly, and it's tax-free. Well, they're right, it's tax-free, but the proper wording is a tax-free investment account. Like you should be buying your stocks, your mutual funds, your higher growth-oriented investments because all growth is sheltered tax-free, not just interest. The banks love it when you put high interest savings stuff in there because they can reloan the money at a much better rate. But I still see it. I'm shocked by it because you can put up like 100 grand in a tax or savings account. Now it is not a small nothing account. It's a major part of wealth building. So it would be. I'm seeing it less, but I'm still seeing it.
Amazing. Well, I'm in agreement with you right there because the rates that banks give us is completely moronic, if I may say. Your regular savings account is what, a 0.01%
It might
APR?
be a bit higher now because like interest rates are up, but they'll give you even a teaser rate of 2%, even on a tax or savings account. That gets you in the door, and then 3 months later they'll drop it down.
Uh,
And if it's really for a short-term cash thing, that's great. But these are retirement accounts. These are long-term compounders. When we invest, we need to think in net return after tax and costs and inflation. Like that is the real value to the client and to the individual. And the TFSA is an amazing way to get real return because all your money is tax free and it can really compound at a very high rate if it's invested in something with a longer time horizon. And excellent for estate planning, excellent for obviously creating a tax efficient cash flow when you need it, which is generally in retirement.
So walk us through a situation, if recent memory serves, where you've had to reallocate some of the funds in a tax-free savings account to something a bit more long-term and not just 1 or 2% or something that just beats
Yeah.
inflation.
Anytime you talk to a bank client, you pretty much have to deal with that. But yeah, I mean, I could give you maybe a better picture of kind of like how we would look at the overall picture. Because generally, what we would find is people have some mutual funds over here, they have some RRSPs over here, they have a tax or savings account over here, but they're not really working together as one organism. And you can even take that a step further, saying like, do I have real estate on the side as well as an investment? And they're not looking at it as a whole. They're kind of just throwing investments and a lot of times it's just cash in some of these accounts, and they're not actually allocating it into the market. The way I look at it is when I would create for our clients what's called a tax efficient portfolio. So that'd be a portfolio that streamlines growth for the highest tax efficiency within your risk profile. So you don't want to take on more risk or less risk than you're comfortable with, but within that, we want to make sure we're paying the minimum amount of tax. And we're maximizing our growth. So the way that I would look at that, I mean, this is for like an average earner, let's say you make, 100 grand. You want your tax or savings accounts to be your highest growth oriented investments because you want to shelter that growth. You would actually want your RSPs to be relatively lower growth earning investments, higher income bearing investments, because they're still sheltered and deferred, but when you pull money out of an RSP, it's fully taxable. So if there's an area of your portfolio you actually want to grow the slowest, it would be your RSPs because it's fully taxable as income when you draw it. And then in your non-registered accounts, you want capital gain oriented investments like stocks or real estate. So if you could build that model, you should pay the least amount of tax today and have the most tax efficient cash flow in retirement. And that will give you better returns overall because at the end of the day, it's not the return number, it's the net return number after taxes and inflation that actually matter.
Amazing. So you have a lot of value to provide. However, I'm sure as much as you want to help everybody, you're probably not going to be able to do that. So who do you like helping out the most, or who do you prefer working with?
Yeah, I mean, I think the number one thing, honestly, is personality. I mean, we don't work with everybody. We work with select people and families. And we want to make sure that there's going to be a good working relationship. So that really is my number one criteria: is will they take our advice? Do they believe in the process? Do they actually want to engage and make the best possible situation for their family? I mean, I say that, but there's a lot of people out there that neglect their finances. That really don't have a lot of interest in focusing on it. That's not
Mhm.
really our clientele. Like if you're gonna not answer an email or not call us back, and we're not gonna talk to you for a couple of years. That's just not the clientele we're looking for. We have some general niches that we just kind of seem to focus on, but generally it's business owners, because there's a lot more complexities there. But we also executives, like sales professionals and executives with like complex compensation packages like RSUs. Like they need that touch point because there's a lot going on and there's a lot of tax planning that goes with it. Sales professionals and business owners that are regular income, and high earnings generally, there's a lot of complexity, but a lot of opportunity. And if we do it properly, we can really open up some doors.
So, speaking of these people you prefer working with, has there been a story that you can share with us about maybe a complex situation that they went through and with your help, they came out on top?
Yeah, I mean there's plenty. I mean, so I'll think of kind of one kind of off the top of my head here, but we had a client that was in a private equity, private company, but that happened to go through a sale or an IPO, depending on I think it was an IPO this one actually, but they walked into about $1 million. So the nice thing
Mm,
was we did know this was coming. So they were unfortunately enough to be a Canadian business. So what we ended up doing actually is we decided that ownership of the shares for 2 years actually would be beneficial. So they qualify for the capital gains exemption, which means that the first $1 million of gain is actually tax free. So it ended up saving them like 300 grand in taxes. And then once we had that money, they wanted to start buying a property. So we, had them buy a property, got them in touch with our mortgage people to make sure they had the best rate, our accountant to make sure that they're filing their taxes correctly as well. And we did that overall process, and then eventually started investing the money in that type of tax efficient portfolio to make sure
mm.
that they were obviously getting the long term results within that context of the plan. But even before that, we were putting money in FHSAs, the new first time home buyers, because that came out recently. Tax savings accounts, RRSPs allow you to take 60 grand out now for first home buyers. So we positioned everything knowing a home purchase was coming, but we knew this complex event was going to happen. And we ended up pretty much eliminating 95% of their tax bill because of how we structured the shares. That's not always the case. Sometimes you got to pay the tax. We live in Canada. Planning ahead of time and having those conversations earlier rather than after the fact, there generally are some things that we can do, or at least plan to contribute to certain accounts to offset some of the tax liability. So your net worth over time is maximized.
Amazing. You mentioned something about efficient tax planning. Could you tell me what that means? And if I can't, let's say if I don't qualify for that level of help, what can I do as you know, as an average Joe, let's say, to be efficient at tax planning?
Yeah, so well, it depends on what type of investment you're doing. I think that this is where it does get complex. I always say talk to a professional. I'm going to say that right now. And I'm happy to talk to someone, even if I can't work with them, I'll point them in that right direction because every situation is unique. And I want to stress that. Like giving blanket advice is sometimes challenging. But with that said, if you know the structure of the investment that you currently have, you can start to try to mitigate some of those things. So, for instance, if you have a rental property, right, and
Hmm.
it's generating income as an investment, that's obviously very tax inefficient income. But any revenue generating asset, any debt that's on it is tax deductible. So, if you have a principal residence and a rental property, the goal generally is to maximize the debt on the rental property to offset as much income as possible because all the debt there is tax deductible. Where on a principal residence, it is not tax deductible. I'll give you an example. You had $500,000 mortgage on your $2 million principal residence, and you had $500,000 mortgage on your $1 million rental property. You really want there to be 800,000 on the rental property and $200,000 on the principal residence. Same amount of debt, but that full 800,000, all the interest earned is tax deductible, which is effectively cheaper after tax, which means you pay less money, pay that you have more cash flow. So that's how I would structure it if you're looking outside of investment accounts. If it's within investment accounts, you want to make sure your interest bearing investments are generally in an RSP. This is general. You want to make sure your growth oriented investments, the ones that have the most potential to grow long term, are in something like a tax or savings account because you want to maximize what that account will be later on down the road. And then obviously, depending on your tax rate, if you're under like 80-ish grand, dividends are more attractive in a non registered. If you're over that, it's generally capital gains, but there's like a formula there. So those are rough numbers. I would say, I know they will change with our tax laws. Roughly, that if you're building your own portfolio, that's how I would try to structure it to make sure that you're paying the least amount of overall tax so you get the most compound.
Cool. So for the average Ontarian out there, there are options available to essentially plan your taxes accordingly. Now, what's a mistake that you're seeing them making that maybe they come to regret later on, or maybe they haven't realized the implications of that mistake down the line?
The biggest issue, and I would say regret, is a failure to plan. I mean, it is unanimous across the board. And one that honestly, I mean, I see quite a lot is people put money in RRSPs without a plan to withdraw it.
Mm,
So RSPs are an amazing tool. They get a really bad rap because people don't use them properly, don't plan with them. But essentially
mhm,
what they do is they lower your income. So if you made 200 grand a year, and you put a 10,000 to an RRSP, it's as if you only earned 190. So that top 10 grand, you would get a tax return because you've already paid tax on it, or you would owe less tax if you're self-employed. So the
Mm,
compound of getting that money today rather than just going to the government can be huge over time. But the failure is people relentlessly put money into RSPs because that's what they think they should save their money. And they're not thinking about why they're doing it, and they're not thinking about how they're going to draw it out. Because to pull that money out in retirement, it increases your income. It can become very expensive. And if your income gets too high, you might lose things like OAS, being a higher bracket, more taxes. It gets more and more expensive the more money you make in retirement. So you want to balance it out and have a plan to have a stable income and have the lowest stable income between generally a couple. And I would say that's one thing that people generally neglect. I have a lot of clients that come to me when they're 63 years old. They're like, I'm ready to retire. Rod, help me with my stuff, and it's like they got 1.5 million in an RSP, and there's just so little I can do with it at that point because it's already in that account. Whereas if I had that client when they were 55, I could have said, you know what, we're getting quite close to retirement. We might want to actually take a little bit more tax today and start maxing out tax-free savings accounts and other accounts because that will allow us to keep our income low in retirement. And I'll give you an example. You're retired, you're 68 years old, and you got to redo your roof, right? Well, where are you going to get the 30 grand from? If you pull the 30 grand from your RSP, all of it is taxable income. So you need to pull out 50 grand. Very expensive. Whereas if you had a tax or savings account, you could pull out 20 grand and maybe 10 from the RSP, keep your income lower and start throttling that tax efficiency over time. But if you don't have the money set aside for it, you haven't planned, you're going to have to pull the money. It gets very expensive, which depletes your retirement fund. So that's the one thing I would say I see the most of. It's just a relentless, not like just putting money away, which is great, great process, but there's no plan on how they need to allocate it. And they're not
mm.
thinking about retirement. They're always thinking about getting to retirement.
There's a phrase I want to say that's thrown out there quite a bit, and lately a lot more, or maybe because I've been reading about it a lot more. Financial freedom. What does that mean? What does it mean to you?
Yeah, it's like, everyone says retirement and this, and like, I think it's almost a dangerous word because people are like, I don't know if I want to stop working or not. Financial freedom is when you could pick up your stuff and you could walk out of your job if you want. You can do what you want with comfort. And I call it personally a decision age. It's an age where if you said, hey, I don't want to go to work today anymore and I'm done, you can just not go to work and there's zero consequences to doing that. It's not going to impact anything. You're doing something because you enjoy it. That's freedom.
That's not the same as being rich on paper now, is it?
Doesn't have to be. It depends on what your freedom is, right? Like I know I have clients that have 4 million in the bank and they don't feel free. I got clients with 300 grand in the bank and they feel free because their lifestyles reflect it. So freedom is what you make it, in all honesty. And it's about being comfortable with with your situation, and your freedom would be very different than somebody else's. But it's having a plan for being able to walk away at some point, and I think that's what's key. And then that's liberating, really, once you have it.
Right. It sure is. How do how does your business help homeowners beyond just financial planning? Is there something else that you bring in that most financial planners don't?
The home is probably the biggest investment you'll ever make. I mean, well, the biggest investment is actually yourself. And I always say that your ability to earn income over 20, 30 years is probably the biggest asset you will have. And nurturing that is the most important thing. But the second one is generally the home. Like you're not going to have a bigger upfront, larger purchase that's more, long term than a property. I think where we can come in is just having that fit into the overall picture. And obviously, investments are key, but I mean, I'm a
Hmm.
homeowner myself. I have a rental property. I have a lot of, background in it, and I think real estate is a good investment. It's a great complement to to equities. I don't think we should be invested in 100% in either side, but I
Mm,
like to come with that holistic viewpoint. Am I better than other advisors? I don't know. I mean, like that's all relative to what you're looking for, but we try to give you that picture, that holistic viewpoint of what's best for the client. If they want to be a little more heavy in real estate, we're going to talk about how we can complement that, and some of the risks in that go over here. If they're only invested in stocks, we're going to say, hey, we should probably diversify and you should own something in real estate because it's a different market. It reacts differently. So we try to bring it all together at the end of the day. There's no right or wrong way to grow wealth. It's really about risk management and finding the best approach for a client.
Now, we're seeing a lot of first time home buyers actually becoming homeowners, right? So, a lot of people who could not previously afford are now becoming buyers and they're buying real estate. If somebody listening today has no investments, no budget, but just bought a home, where should they start?
So, I mean, the first thing is if you're buying a home, and I think before you do that, I think you need to be aware that home ownership is more expensive than renting. And this is like another kind of pitfall that generally happens is there's a leap. Like, I mean, I remember the first I bought my home within a month, I had to buy a new furnace. Like it was crazy. And there goes 15 grand. It was like immediate. You always have to budget for something going wrong. And what people generally don't connect immediately on when they're a first time home buyer is that, I spent 3 grand a month in rent, my mortgage is 3 grand, I'm good. But you got property tax, you've got utility bills, you've got, all these other things, you've got repairs, things are going to break, you own this place. So it's going to take a little bit more to upkeep. So make sure you're ready, I think is number one. But I think where should they start? Um, I would not generally buy a home either until I had some nest egg built up as well. And I think I wouldn't go to zero because things are going to go wrong. And it's going
Mm.
to be harder to save once you buy than after. Like you're going to better cash flow, less expenses. So I would try to build a little nest egg before and then don't use all your money, then buy the home. You have some safety net if things go wrong, and then jump into the market. And the reason being is investing is compound. What do they call like the eighth wonder of the world is compound interest? I know, like I thought maybe it's a Warren Buffett quote or something, but like it is true. And the first 100 grand is the hardest to earn because you pretty much have to do it all yourself. The second 100 grand is a lot easier, right? The third 100 grand is much easier. And then after that, when you're at $1 million, 10% is 100 grand. You can earn it in a year. So you don't have to do anything. So it's about getting that rocket ship off the ground. It's very, very slow. And then it kind of compounds. It goes faster and faster. If you go to zero, then you're off the ground, you're putting it back on the ground, and then you got to relaunch it. And you have no buffer if anything goes wrong. So I would always say, take your time, save it, find the right opportunity. There's been a lot of panic in the market, but I have to get in now. I have to do this. Markets go through cycles, and the cycles that we were in 5 years ago were frankly crazy. I mean, on the real estate side, unless you needed it, you had to buy it. I get it. You have a young family or something like that. But now we're noticing it's softening. Real estate goes through ebbs and flows like any market. So, do the right thing for you. Make sure you can afford it. It fits within your budget. And then, then you execute, but put yourself in a good position before you do it because once you're in, it's going to be tougher and tougher to build that retirement nest egg, and you'll be forced to sell your property if you don't do it properly.
Which we're seeing a lot more of. And
Unfortunately,
essentially, it's sad, but the reality is don't plan to be house poor, right?
yeah, like,
Have that
and then it
nest egg.
sucks. It's like a living standard too. I mean, there's in some cases there's nothing wrong with renting. It gives you if it gives you flexibility. We have this mentality that you absolutely have to own. I think that ownership is great. I'm one of them. I'm not going to say it's wrong, but I don't. It's not necessary. If you have better cash flow and you have more to invest, you need assets. You need assets working for you, and you need to find the right plan for you. And hopefully that includes home ownership because there is some pride in that, but it's not necessary if for the right person, right? And I think that's something people always think they have to get in at all costs and they end up becoming very house poor. And then it puts them in a very poor position down the road where they're forced to exit the housing market just to live or retire. And that's not really great either because you could be forced to sell in a bad market. And that's where things can get.
Amazing. Well, as we're wrapping it up, two more questions for you, Rod.
Yeah, no problem.
I'm thinking about hiring a financial planner, but I have no idea where to start. What are three questions every homeowner should ask their financial planner?
A good question. I mean, I think number one is if you're looking for a financial advisor, I would probably interview at least 2 to 3 people. And obviously, if I'm one of them, that's great. I think it's a more important you find the right fit for you than just find the first person. Everyone's got a different personality. There's a lot of great advisors out there, but it is a personal relationship, and I want to stress that. So I would interview people first. So get a gauge of what your options are, and then find that, where you have that good connection, you believe in their philosophy, because everyone runs a different practice. A couple things that I would definitely look for is, are they a CFP or a certified financial planner? And that's like the highest level designation for financial planning. So you're getting someone that is accredited. They are an expert in financial planning and holistic wealth management. So, and they're a fiduciary too with that
Hmm.
license. So they're going to do what's in your best interest. It's part of their licensing and their designation. So I think that's super important if you really want to get that holistic viewpoint. I personally would also look for someone that is discretionary as well, or a portfolio manager, because it will allow them to act on behalf of the client in their best interest within the portfolio. And I think that's important because clients are busy. And this is what we found is, like, some clients want to be very hands-on. And I guess that might not be the best fit for a super hands-on client, but most clients are busy doing what they are good at. I'm not going to tell a plumber how to change a faucet. And if there's an opportunity in the markets, this type of person can take advantage of that opportunity because you've given them parameters to work within, and they can go buy that stock if they see a really good price uh, at 2 p.m. on a Tuesday, where you might be in a meeting and you wouldn't be able to pick up the phone. So I think
Right.
that's super important to focus on. And then I would just get a clear understanding of fees and how they work. I think that's important. Cost is an issue in the absence of value. I mean, you don't want the cheapest guy out there. You don't want the most expensive, but is it fair, and do you understand it? And are you aligned with that advisor? I think that's the most important thing, because everyone's got a different structure. Like, people that are doing commission trades, that's probably not the greatest thing, because their incentive is to trade, not to grow your wealth, to move money. You want someone that's probably in a fee-based system where, they're attached to your growth. I would say that's generally where there's no transactional cost. The goal is to manage money. It's a wealth management fee, and it's a little more aligned. That's what I would look for personally, but it really also depends on what the client is looking for as well. I mean, if they want someone really hands-on, then maybe
Mm.
transactional is a little bit better. But do your homework.
Amazing. So if I win $1 billion, billion with the B tomorrow
Okay,
on a
I'm
Lotto
into it.
Max
Yeah.
ticket, I need to talk to you.
Sure,
Essentially, and two other
I'll take
people.
$1 billion. Yeah, no, I mean, if you win any money, you should talk to an advisor. And I think there's tremendous value in obviously our profession. Maybe that's biased. Obviously, I'm in it, but you know, the one thing I will say is that a lot of people have an advisor and they don't talk to them, and they're paying them quite a lot of money. I mean, in most cases, it's like 1 to 2% a year. And
Mm.
you can do the numbers. If you have $1 million, it's like 10 grand to 20 grand. If you have 500 grand, maybe it's $5,000 to $10,000 a year. It's a lot of money to be paying a professional. So you need to make sure you're getting value for that money. There's a lot of advisors that are earning their keep, and there's a ton of value. And I think that if you have a good advisor, there's a lot of metrics out there within the tax efficiency planning, the financial planning, the portfolio management. You should be getting a few percent of value out of them every single year that covers their cost. But if you have one review a year, one every couple of years, and there's no financial planning aspect in it, you're probably overpaying by quite a lot at this point in day and age. It's more of a consulting, you know, relationship where the advisor deeply knows you. So if you have any money, honestly, you should talk to somebody. But $1 billion, you definitely should be talking to someone. Most, yeah, that would be a big one, and you need some help with that one. I would probably talk to someone, to be honest. I'd be talking
Well,
to
the
someone with
idea
billion
is
bucks.
if you win that lottery, you don't want to be the statistic that lose it all in 6 years,
You don't.
right?
You don't. But it's a lot of us. The lottery is our ability to earn income, right? Like, the lottery is, I make a few hundred grand a year, and if you look at that over a lifetime, that's the lottery, right? If you manage it properly and you manage it for a long period of time will do the work for you. Honestly, like, people that start investing in their 20s and the early 30s, very wealthy if they do it properly, even with relatively low incomes. People that start in their 50s, even with high incomes, much less wealthy. And it's just because time could compound and do a lot of that work. That rocket ship, if you get it lifted off when you're 25 or 23 years old, by the time you're 30, 35, it's already going, and it's starting to do a lot of the work for you. And you just have to let it do the work. You just have to sit back, talk to somebody, because well, with the Scotiabank things, you're probably richer than you think, right? I mean, you probably are
I
if
think
you get,
that's the biggest lie that a bank
yeah,
has ever said.
yeah,
But
yeah,
time for
probably, yeah.
another discussion.
Yeah, and I mean, because they say that, but you need, like, you if you structure things properly, there's ways to make
To
that
make it
future a
come true.
reality, right? But if you don't, and you push it off for next year, push it off for next year, which most people say, I'm busy, I'll deal with it later, you're losing your biggest asset, which is time. And time is your friend until it's not. And at some point, it will not be your friend. When you're 4 or 5 years up from retirement, very little that time will do to help you, unless you want to delay retirement, which obviously is never something we want to do. So, yeah.
Cool. Finally, you've mentioned that you're a homeowner. You've mentioned it a couple of times now. So let me ask you this. What does it mean to be an Ontario homeowner?
Well, um, it was hard to get into the market, I'll tell you that. I mean, well, I bought my first condo back in 2017, so I got a little lucky. I kind of got the ramp up, but I still owned it as a rental property, and it's been choppy in that area. So I guess there's some stresses in it, but I always found it's like, whenever you jump into a property, it's this massive change. It's almost overwhelming, right? You're like, how am I ever going to afford this property? But then as time goes by, it kind of calms down, and then you're like, oh, this is not so bad. I'm comfortable once you hit your grooves. It's um it's wonderful to have your own space that you can call yours. It's been challenging, I think, as well. I mean, I said I moved in 2022. I moved with a 1-month-old baby. I don't recommend that. So that was an experience I wouldn't want to go through again. But especially with interest rates and everything like that, it's definitely been a challenge. And I'm noticing a lot of clients are going through that challenge too. But being a homeowner, I look at it as just it's another cog in my portfolio. I mean, it's a great diversifier. It's a great asset. Generally, long term, it does well, and if it's managed properly and there's not too much risk, which is honestly debt, it's appropriate. No, and you get to enjoy it. How do you beat that? Yeah, no, I love
Amazing.
it. We love it. We love it. Got a good backyard, two young kids, and they rip around in there, so it's a lot of fun.
Amazing. Rod, how can people find you?
Yeah, so if you want to look us up, probably the easiest way is to go to our website, which is egwealth.ca, or give us a call, send me an email. I'm always open to helping people where I can. But whether you're a direct, fit for what we do or not, we like to be a resource. And I truly do believe that, helping people is important. I'm not going to turn you down if you give me a call. I offer a complimentary consult to everybody. So book a time, have a chat, and if we can help you directly, I'll give you some pointers on the right direction to go to kind of get your situation sorted, whether that's anything from an accounting, debt management or whatever. We'll figure out the right solution for you at this time. And if it's something we can directly help you with, then we'll continue the conversation. But, you know, look me up, email or even my Calendly link, best way to get me, and happy to have a chat.
Perfect. Folks, that's a wrap on this episode of the Ontario Homeowner Show. Now, I do not know what part resonated with you the most, but here's what I hope you took away. The guests we bring on the show are change makers. They're out here doing work that makes your life better. One home, one family, one conversation at a time. If that's something you want more of, hit subscribe wherever you're listening. New episodes will be dropping weekly. And if you want the highlights, tools, and guest takeaways straight to your inbox, go to ontariohomeownershow.ca and leave us your name and email. Thank you for listening in today. See you in the next one.